What's good, traders? Hope you guys are doing good and welcome to my YouTube channel. In today's video, we're going to be talking about market makers. And in this video, I'm going to be giving you guys a brief description of what they are, what their business model is, and also what their role is in the trading space. So if you want to learn more about that, stay tuned. So before we get into market makers, I just want us to be clear on this topic, the parties that exist in Forex, right? And I'm going to make the assumption that you've either been taught two things about Forex market. Number one, that you've been taught that the market is simply just an interaction between retail traders who want to buy currency and retail traders who want to sell a currency. And to an extent, that's true, but that's not entirely the case, right? One flaw in that statement is that it implies that when you want to buy a certain currency, Jabu out there is simultaneously selling. So for there to be a market, Jabu always has to be there to sell that currency to you. Now, in a situation where, say, for example, most retail traders are positive or the sentiment towards a certain stock or security is optimistic, right? It implies that the price won't move, right? Why? Because no one is willing to sell. Let me explain it to you like this. Right now, it's winter. If it's winter, it means that demand for oranges is high, right? If there's no one at all being who's able to supply oranges, will there be a market if all of the people are demanding oranges, but there's no one who's willing and able to sell those oranges? No. A market exists when there's a buyer and there's a seller. But if there's no one to sell those oranges, a market does not exist. So that's the flaw in the statement that the market is just people or retail traders who want to sell and retail traders who want to buy. Because if most, if not all retail traders are positive on one direction, it implies that there won't be any market because there's no one on the other side, right? Also, another assumption that's been roaming around most of the time is that the market is simply an interaction between retail traders and banks. And it implies that the Forex market revolves around retail traders. And that's not true. In actual fact, retail traders contribute a small portion to the famous 5 trillion that's traded within, that's traded every day, right? But we'll get into that in future videos. What I want you to understand for now is that the market consists of two people, customers and market makers. Customers are people who want to buy and sell currency. Everyone coming into the market to buy a certain currency for different reasons, either for speculative reasons. So these are us retail traders wanting to go into the Forex space to buy a certain currency because we believe it's going to go up it's going to appreciate in value and we want to pocket the difference. And also we sell a particular currency because we believe that it's going to drop in value. So we want to pocket the difference and make profit from that. So that's speculative reasons, or for utilitarian reasons. If you have a company in South Africa and you want to purchase machinery in China, you have to convert your currency from your local state to the yuan. I don't know how to pronounce it, right? So, or you have to use US dollars. So these are the people who are different, who are interested in the buying and selling of a currency for different purposes. And market makers are the people who provide a facility for that to happen. So one of the reasons why you are able to, say, for example, sell EURUSD and your trade is able to be filled within seconds is because of these people, market makers, because they're always on the other side, willing and able to fill in your order, regardless of the direction that you want to take, right? So customers consist of banks, hedge funds, retail traders, tourists, insurance companies, etc. Like I said, these are people who are interested in converting their currency from their domestic state into different currency for different reasons, either for speculative reasons, either to purchase assets in a different country, either to purchase goods from a different country, or if you're a tourist, you just want to be able to buy goods and services in a different country, right? And then market makers mainly consists of brokerage firms. So I think I gave a brief description of what market makers are, but if you want the textbook kind of definition, market makers act as counterparties to investors' trades in the general equities market. This means when an investor wishes to buy a security, they will always be on the other side of the trade, selling the security, right? And the opposite is true for when an investor wishes to sell, meaning they will always be on the other side to buy that security. This happens regardless of whether they believe the trade is likely to be in their interest or not, right? As counterparties to your trades, this is for speculative reasons. If you lose, they make a profit from your losses. When you make profit, they lose money, right? So let's say you wanted to buy Euro USD, and then it's going up, it means you're making profit. I think that's very simple, right? You understand what that means. So their role in the ecosystem is to provide the markets with liquidity, right? And we'll talk about what liquidity is in the next video, hopefully dropping next week or two, and ensuring that the markets are stable and efficient. One of the reasons why liquidity is so important in our industry is because transactions happen like in a very fast-paced manner. So if there's no person acting as a counterpart, you'll understand the disaster that will happen. Right? So the best way for you to understand what a market maker is, how I explained market makers to myself initially, because I also didn't understand. I used the analogy of a car dealership, right? So we all know a car dealership is a marketplace where you can sell your car or you can purchase your car. So their business model is to provide a facility for a person who wants to get rid of their car to be able to sell to a person who actually wants their car. That's their business model. And they pocket the difference. They purchase this car at a lower price and then sell the car at a higher price. For them, it's called a markup. For market makers, this is called spreads. So when you go to your MetaTrader or any trading platform, you'll see that there's two different prices, purchasing price and selling price. And the difference between those two are the spreads. So yeah. That's what I said in the next slide. They provide their own codes, usually matched by interbank prices. I'll explain this in the liquidity video. And this allows them to buy at the best bid prices available and sell at the best prices on offer. The difference between the bid, and the ask price is called the spread, and that's their markup, right? So obviously the wider the spreads, meaning if they could buy at the lowest price possible and sell at the highest price possible, the more profit they could potentially make, right? Now, if you've noticed anything about spreads vary within one trading day, or they vary according to different market conditions. So for example, if it's the end of the day, spreads will be wide because generally there's low liquidity during that time. And if the markets are volatile, spreads will also be widened because, again, low liquidity, right? But there's times where spreads are tight. And this is because why? Liquidity is very high at that time. So on times where liquidity is low, they could potentially make a lot of profit. Also because at that time, there's a lot of market makers bidding, because the market does not consist of one market maker, it consists of a lot of market makers. So if you have a lot of market makers placing their codes at the same time, if there are orders, obviously what you see on your end will be tight spreads. But like I said, we'll talk about that in detail in another video, right? So market makers don't necessarily control a market. They don't control a market, they make it. They respond to customer demand and supply. So the liquidity that's available on the market at the specific point in time depends on customer activity. If customer activity is low, then obviously liquidity will be low. If customer activity is high, then liquidity will also be high, right? That's the different spreads. So market making isn't a risk-free business, right? And the spreads that they charge can compensate for the potential losses that they could possibly incur, right? So imagine you're in any other business. If you hold too much inventory, right, you could potentially lose money. So say, for example, you're in the business of selling fresh goods, right? So you have your fresh fruits and vegetables. They have a specific time that they have to be sold in. And if you're unable to sell those goods in that specific time, you'll lose money. So the same thing happens with market makers. They hold inventory either on the buy side or on the sell side. If you have too much inventory on one side, right, and there aren't people who are buying, so if you have too much inventory on the sell, whereas the market is dropping, you're going to lose money. So that's the risk, or that's one of the risks that they incur being in this business. But there are ways to mitigate or minimize these risks. Number one, they adopt hedging strategies. Number two, they trade very small. Most of the time they say that this market, the Forex market, is very decentralized. But we know that in the financial space, even if anyone can enter, usually the barriers of entry is capital. So with market makers, I'd assume that you have to have a large sum of capital to be able to open that kind of business. So also from the capital that they have available, they trade a very small portion from it. What $50 million is to you, to them, is usually a portion of their capital that they have ready to trade. So they trade very small and that they don't use leverage. So I hope this explanation makes sense. Before we conclude, I just want us to sort of like summarize everything that we learned in this video. Number one, market makers are providers of liquidity in the market, right? How do they make their money? They pocket the difference between the ask and the bid prices. Is it a risk-free business? No, there are risks attached to it. And also, what is their role in the trading ecosystem? They provide stability and they ensure that the markets are efficient. And yeah, we'll talk about other things in the next coming videos, but for now, that will be all. So yeah, this is where the video ends. Hope you guys enjoyed it. And see you guys in the next video. Peace.